Disclaimer.
AG here, and yes, the initials stand for exactly what you think. Asian guy tracking American dollars. Normally I'd start with a joke about silver linings, but Russia just pulled off something that makes every cloud in our financial sky look pretty dark. Picture this scenario. You're managing a warehouse that stores silver for investors worldwide. For decades, you've operated on a simple principle. Most customers never actually want their metal. They're happy with paper receipts. So you've been lending out the same silver to multiple people, pocketing fees on both sides, confident nobody would call your bluff. Then one morning in December 2025, the phone starts ringing. And it doesn't stop. Within 4 trading days, customers demanded physical delivery of 47.6 million ounces. That's 60% of everything you claim to have ready for immediate delivery. The problem? You never expected anyone to actually want it. Welcome to the ComEx vault drain emergency. And it's just the beginning of what's happening in our silver markets right now. Here's what should grab our attention. While Western investors have been trading paper contracts and digital promises, Russia quietly made a move that hasn't been seen in decades. They allocated $535 million specifically for silver purchases. Not gold, silver. Think about that for a moment. When's the last time you heard of a major central bank stockpiling silver like it's going out of style? You haven't, because it hasn't happened since the 1960s. But Russia didn't stop at buying. According to trade data compiled by the World Gold Council and cross-referenced with Russian customs declarations, they simultaneously increased their domestic reserves by 4,140 tons while withholding exports. Let me put that in perspective. That's roughly 160 million ounces removed from Western markets in a single year. One country, 1 year. 20% of the global supply that used to flow freely just stopped flowing. Now here's where it gets interesting. Russia didn't act alone, and they didn't act randomly. On January 1st, just weeks ago, China implemented export restrictions that fundamentally changed who controls the world's silver supply. These aren't minor bureaucratic adjustments. China now requires exporters to have production capacity exceeding 80 tons annually and credit lines of at least $30 million. Hundreds of smaller suppliers who previously shipped silver to Western markets can't meet those thresholds. The result? 44 state-approved companies now control access to 60 to 70% of global refined silver supply. You might be wondering why this matters to you personally. Let's connect the dots to your daily life. That smartphone in your pocket contains roughly half a gram of silver. The solar panels gaining popularity across American rooftops, each one requires about 20 grams. Your car, if it's a newer model with advanced electronics, has about 15 to 28 grams depending on the features. Every electrical contact, every circuit board, every photovoltaic cell requires silver because nothing else conducts electricity and resists corrosion quite like it. And suddenly, the countries producing most of this essential industrial metal have decided Western access isn't guaranteed anymore. The timing raises questions that demand answers. Why would Russia prioritize silver over other strategic commodities? Why would China implement restrictions precisely when global supply chains are already stretched thin? And why would both moves happen within months of each other? These aren't coincidental decisions made in isolation. According to analysis from the Bank for International Settlements, coordination between BRICS nations on commodity markets has intensified significantly since 2023. Someone is reading the same data we're about to examine, and they're moving first. Let's talk about that ComEx emergency in December, because it exposes something critical about how our silver markets actually function. For decades, the Commodities Exchange in New York has operated on a fractional reserve system. They maintain 2 categories of inventory: registered silver available for immediate delivery, and eligible silver stored in their vaults, but not pledged for delivery. Think of registered as the silver they promise they can deliver right now, and eligible as silver that might become available if owners decide to sell. Here's the crisis nobody saw coming. When those delivery demands hit in December, registered inventory dropped from 79.3 million ounces to just 31.7 million ounces in 96 hours. 4 days. The silver lease rates, which measure how expensive it is to borrow silver for short-term delivery, spiked to 200% annualized. That's not a typo. Banks and dealers were willing to pay 200% interest to borrow silver they needed to deliver immediately. What does that tell you about how desperate the situation became? The Shanghai Gold Exchange tells an even more revealing story. Physical silver trading in Shanghai hit $80 per ounce during peak demand periods in late 2025, while ComEx paper futures remained artificially suppressed between $30 and $35. Stop and think about what that means. The same commodity, silver, trading for $80 in one market where people demand physical metal, and $35 in another market where people trade paper contracts. That's not a price discount. That's 2 completely different realities. This price disconnect represents the greatest divergence in precious metals history. When London gold markets experienced similar situations in the 1960s, the system collapsed and forced a complete restructuring of international monetary agreements. We're watching the same pattern unfold in silver, except the stakes are higher because silver isn't just a monetary metal anymore. It's an industrial necessity for the technology driving modern life. Have you noticed your investment portfolio lately? If you own silver through ETFs or futures contracts, you're holding a paper promise from institutions that may not have the physical metal to back those promises. According to data compiled by the Silver Institute, global silver markets have accumulated cumulative deficits of 1.3 billion ounces since 2019. That means demand has exceeded supply by 1.3 billion ounces over 6 years. Where did that silver come from? Existing stockpiles, above-ground inventories, the reserves built up during decades of surplus production. Those reserves are now depleted. ComEx inventories are down 70% since 2020. London Metal Exchange vaults show similar patterns. Shanghai inventories hit decade lows in 2025. And now Russia has removed another 160 million ounces, while China controls who gets access to 60 to 70% of new refined supply. Do the math. When demand consistently exceeds supply for years, and the stockpiles filling that gap disappear, and major producers withhold exports, what happens to prices? More importantly, what happens to availability? The physical shortage is real, measurable, and accelerating. Industrial demand hit 680.5 million ounces in 2024 alone. Solar panel manufacturing consumed 232 million ounces. Electric vehicles required 80 million ounces. 5G infrastructure, medical devices, water purification systems, and semiconductor manufacturing add millions more. This isn't speculative demand from investors hoping prices rise. This is manufacturers who need silver to produce the products consumers are buying right now. Meanwhile, global mine production remains stuck at 835 million ounces annually. Why doesn't production increase when demand is clearly rising? Because 75 to 80% of silver comes as a byproduct from mining other metals like copper, lead, and zinc. You can't just decide to mine more silver. You'd have to mine more base metals that happen to contain silver, and those operations depend on demand for copper and zinc, not silver prices. The supply side cannot respond to price signals the way normal commodities do. Let me paint you a picture of what this means for ordinary Americans. Imagine you're planning to install solar panels on your home to reduce electricity costs and increase property value. You've done the research, gotten quotes, secured financing. Then your installer calls and says they can't guarantee completion dates because they're having trouble sourcing panels. The manufacturers aren't getting silver at predictable prices anymore. Your clean energy upgrade gets delayed indefinitely because of commodity markets most people never think about. Or consider this scenario. You're approaching retirement, and your financial advisor suggested diversifying with precious metals. You bought shares in a silver ETF, thinking you own silver, but what you actually own is a claim on silver that might be stored somewhere, might be leased to multiple parties, and might not be available when you need it. When Russia and China restrict supply, when ComEx vaults drain, when physical shortages emerge, your paper investment might retain value on a screen while the physical metal becomes unavailable at any price. The warning signs are everywhere if you know where to look. Physical silver premiums, the amount dealers charge above spot price, have jumped to $8 to $10 per ounce. That's the market telling you physical metal is scarce even as paper prices remain suppressed. Coin dealers across America report waiting weeks or months for inventory that used to arrive in days. The United States Mint has struggled to meet demand for silver eagles, our country's official silver bullion coin, multiple times in recent years. What we're witnessing isn't just a supply squeeze or a temporary disruption. This is a structural transformation of global silver markets engineered by countries that control production and backed by mathematical realities about supply and demand. Russia allocated $535 million and removed 20% of global supply from Western access. China implemented restrictions that place 60 to 70% of refined supply under state-approved control. And ComEx, the exchange that's supposed to guarantee price discovery and delivery, suffered a vault emergency that exposed the fractional reserve scheme propping up paper prices. The question isn't whether silver prices will rise. The question is, what happens to industries, investments, and individuals when physical supply becomes unavailable regardless of price? What happens to manufacturers who can't secure silver for production? What happens to investors holding paper contracts when delivery fails? What happens to American energy independence when solar panel production depends on commodities controlled by foreign governments? These aren't hypothetical scenarios or distant possibilities. They're unfolding right now in real time, and the pace is accelerating. Every week brings new data confirming the trajectory. Every month sees another vault drained, another delivery demand exceeded, another price disconnect widened. The mechanisms are in motion, and understanding them is the first step to protecting yourself from what comes next. Let's get into the hard evidence, because what I'm about to show you isn't speculation or theory. This is documented policy backed by trade data you can verify yourself. China's Ministry of Commerce published the new export licensing requirements on December 15th, taking effect January 1st, 2026. The document specifies exactly who can export silver from China moving forward, and the barriers they've created are precisely calculated to eliminate competition. Here's what the licensing system actually requires. Any company wanting to export silver must demonstrate annual production capacity exceeding 80 tons. They must maintain credit lines of at least $30 million. They need established relationships with state-approved refineries and documented compliance history with Chinese commodity regulations. According to industry reports from the Shanghai metals market, roughly 300 smaller silver suppliers previously exported to Western markets. How many meet these new thresholds? Fewer than 50. And of those, only 44 received state approval to continue operations. Think about what just happened. China didn't ban silver exports. They're smarter than that. They created bureaucratic requirements that sound reasonable on paper, but effectively consolidated control under companies with strong government connections. Those 44 approved firms now decide who gets Chinese silver, at what price, and under what terms. When you control 60 to 70% of global refined supply, you don't need to ban exports. You just need to control the gatekeepers. The immediate market reaction confirms how significant this shift really is. Physical premiums, the amount you actually pay above the quoted spot price, jumped from $2 to $3 per ounce in November 2025 to $8 to $10 by late December. That's not a gradual increase reflecting normal supply and demand adjustments. That's panic buying as industrial users scramble to secure material before the restrictions fully bite. When dealers and manufacturers are willing to pay 3 times the normal premium, they're telling you something fundamental changed in the market structure. But China's restrictions only make sense when you understand the supply deficit we've been running for years. The Silver Institute, which tracks global supply and demand with data from mining companies and industrial users, published their 2024 analysis showing something remarkable. For 5 consecutive years, silver demand has exceeded supply, not by small margins. We're talking cumulative deficits totaling 800 million ounces between 2019 and 2024. That's nearly an entire year of global production that came from somewhere other than mines. Where did 800 million ounces come from? Above-ground stockpiles, inventories built during decades when supply exceeded demand, vaults in London, New York, and Shanghai that stored silver from years of surplus production. But here's the problem with drawing down stockpiles to fill persistent deficits. Eventually, you run out. And according to data from the London Bullion Market Association, their vaults held 40% less silver in 2025 than they did in 2021. 4 years, 40% gone. Shanghai Silver Exchange inventories hit their lowest levels in a decade. The reserves that buffered the market during deficit years are nearly depleted. Let me break down where this demand is actually coming from, because understanding the buyers helps explain why the shortage won't resolve easily. Industrial demand hit 680.5 million ounces in 2024 alone, according to Metals Focus research commissioned by the Silver Institute. Solar panel manufacturing accounted for 232 million ounces. Think about that number. Solar panels alone consume more than a quarter of total industrial demand, and solar installations are accelerating globally as countries pursue climate goals and energy independence. Electric vehicles required another 80 million ounces in 2024. Every EV contains significantly more silver than traditional vehicles because of the electrical systems, battery management, charging infrastructure, and advanced sensors. As American automakers ramp up EV production to meet regulatory requirements and consumer demand, that 80 million ounces is projected to reach 120 million ounces by 2027. The technology transition everyone supports is literally built on silver. Here's where the math gets uncomfortable for anyone holding paper silver investments. Global mine production sits at 835 million ounces annually. That number has remained relatively flat for years, despite rising prices and growing demand. Why can't miners just produce more silver when the market clearly needs it? Because of how silver mining actually works. And this is crucial to understanding why we face a structural shortage rather than a temporary imbalance. According to the World Silver Survey data compiled by Metals Focus, 75 to 80% of silver production comes as a byproduct from mining other metals. Copper mines, lead mines, zinc operations. The silver comes along for the ride, but it's not the primary target. When copper demand determines how much copper ore gets processed, the silver contained in that ore becomes available, regardless of silver prices. You can't simply decide to mine more silver without mining more base metals that happen to contain silver. The supply side cannot respond to price signals the way normal commodity markets function. This creates a fundamental problem for market equilibrium. When silver prices rise, gold miners can increase production by opening new gold mines or expanding existing operations. When oil prices spike, drillers can tap new wells and ramp up extraction. But when silver prices double or triple, the supply response is limited because most production depends on base metal mining economics, not silver economics. Miners will produce more copper if copper prices justify it, and will get whatever silver comes with that copper, but they won't significantly increase copper production just because silver prices are high. Now let's talk about backwardation, because this technical term describes something critical happening in our silver markets right now. Normally, futures prices trade above spot prices. If silver costs $30 today, a contract for delivery 6 months from now might cost $31 or $32. That premium reflects storage costs, insurance, and the time value of money. Backwardation occurs when this relationship inverts, when spot prices exceed futures prices, when having physical metal right now is worth more than a promise to deliver that metal later. The silver market entered sustained backwardation in mid-2025 and has remained there through early 2026. According to CME Group data tracking ComEx futures prices, spot silver has traded above 6-month futures by 50 cents to $1 per ounce for months. This signals acute physical shortage. It means market participants value immediate possession over future delivery promises. When backwardation persists, rather than appearing briefly during temporary disruptions, it indicates structural supply problems that won't resolve quickly. Let me connect this to something tangible you might experience in daily life. Imagine you're shopping for a new laptop. Normally, retailers offer pre-orders for upcoming models at slightly lower prices than current models, rewarding customers willing to wait. Backwardation would be like the store charging more for the future model than the one available today, because they're not confident they can actually get the future model. They value having inventory now over promises from suppliers later. That's what's happening in silver markets, except we're talking about industrial metal critical to manufacturing, not consumer electronics. The demand-supply imbalance for 2025 tells the whole story in stark numbers. Total silver demand reached 1.24 billion ounces. Total supply, including recycled silver, reached only 1.01 billion ounces. That's a 230 million ounce deficit in a single year. To put that in perspective, Mexico is the world's largest silver producing country, mining approximately 189 million ounces annually according to the U.S. Geological Survey. Our annual deficit exceeds Mexico's entire production. We're consuming more silver than the top producing country can mine. Some analysts calculate the deficit even larger, reaching 295 million ounces when you account for industrial demand that doesn't get reported in official statistics. Small manufacturers, artisanal operations, developing markets where tracking is imperfect. Either way, whether it's 230 or 295 million ounces, we're depleting above-ground stockpiles at catastrophic rates. And now Russia has withheld 160 million ounces, while China controls access to the majority of new refined supply. You might be wondering how this affects your retirement planning, your investments, your financial future. Let me make it personal. If you own a traditional IRA or 401k, there's a decent chance your portfolio includes exposure to mining companies, technology firms, or commodity funds that depend on stable silver supplies. When manufacturers can't secure silver at predictable prices, production costs spike, profit margins compress, and stock valuations adjust accordingly. Your semiconductor holdings, your renewable energy investments, your technology sector exposure all carry hidden silver supply risk that most financial advisors never mention. Or consider inflation protection strategies. Many Americans turned to precious metals during recent inflation concerns, buying gold and silver as hedges against currency devaluation. But if you bought silver through an ETF or paper contract, rather than physical metal, you're exposed to counterparty risk that most people don't understand. When the fund claims to hold silver backing your shares, do they actually have physical metal in a vault? Or do they have contracts with dealers who promise to deliver metal when needed? And what happens when those dealers can't source physical silver because Russia withheld exports and China restricted access? The evidence from vault inventories paints a troubling picture. LBMA vaults in London held 950 million ounces of silver in 2021. By late 2025, that number dropped below 600 million ounces. That's not a gradual decline from normal market operations. That's a structural drain, as physical buyers remove metal from the system faster than new supply can replenish it. Shanghai inventories fell from peaks above 200 million ounces to barely 100 million ounces. ComEx registered inventories, as we discussed, got drained by 60% in 4 days during the December emergency. What happens when vaults empty while demand continues growing? Basic economics suggests prices should rise until demand destruction occurs. People stop buying when prices get high enough, but what if demand can't be destroyed because it's industrial rather than discretionary? Manufacturers need silver to produce solar panels regardless of price because the alternative is shutting down production lines. Electric vehicle makers need silver for electrical systems. regardless of cost, because regulations require EV production, and no substitute material provides equivalent conductivity and reliability. This is where our situation differs fundamentally from typical commodity cycles. Yes, prices will rise, but rising prices won't substantially reduce demand because most demand is inelastic, and rising prices won't substantially increase supply because production depends on base metal mining economics. We face a market where the normal adjustment mechanisms that restore equilibrium don't function properly. Shortages persist, physical premiums widen, and paper prices lose connection to physical reality. The data I'm sharing comes from official sources you can verify yourself. The Silver Institute publishes annual World Silver Survey reports. The London Bullion Market Association releases vault inventory data monthly. CME Group provides daily ComEx futures and inventory numbers. Chinese Ministry of Commerce documents are public record. Russian trade data gets compiled by international agencies tracking commodity flows. This isn't conspiracy theory or speculation. These are documented facts about supply, demand, inventories, and policy changes that are reshaping silver markets right in front of us. Understanding the evidence is essential because what comes next depends on mathematical realities, not predictions or opinions. When annual deficits exceed 200 million ounces, when major producers withhold supply, when vault inventories drain, when industrial demand grows faster than mine production can increase, the outcome follows from basic arithmetic. You don't need to forecast future behavior or guess what central banks might do. You just need to accept what the numbers tell you about supply, demand, and the inevitable conclusion when they remain imbalanced. Let me show you the math that keeps commodity traders up at night, because when you run these numbers, there's only one logical conclusion. ComEx registered inventory currently stands at 82 million ounces. That's the silver available for immediate physical delivery to anyone holding futures contracts who demands actual metal instead of cash settlement. 82 million ounces sounds like a lot until you remember what happened in December when delivery demands hit 47.6 million ounces in just 4 days. Do that math with me. If delivery demand continues at December's pace, ComEx registered inventory can satisfy about 10 days of deliveries before running completely dry. 10 days. The exchange that's supposed to be the global price discovery mechanism for silver, the institution that handles billions of dollars in daily trading volume, has enough physical metal to last maybe 2 weeks if buyers keep demanding delivery at recent rates. And here's the uncomfortable question nobody wants to answer. What happens on day 11? The traditional answer involves moving silver from eligible to registered status. Remember, eligible inventory is silver stored in ComEx vaults, but not currently pledged for delivery. Vault owners can transfer it to registered status if they choose. As of early 2026, ComEx holds about 240 million ounces in eligible inventory. That should provide a cushion, right? Except those owners have no obligation to make their silver available for delivery. They're storing it in ComEx vaults for security and convenience, but they can remove it anytime or simply refuse to register it. When push comes to shove, will private owners surrender their physical silver to save the exchange? History suggests they won't. During the London gold pool crisis in the 1960s, when Western central banks tried to suppress gold prices by selling from reserves, private holders simply waited for the inevitable price adjustment. They knew the suppression scheme couldn't last because the math didn't work. Eventually, the pool collapsed, gold prices exploded, and the monetary system got restructured. We're watching an identical pattern unfold in silver, except this time it's not just central banks playing games with paper prices. It's an entire exchange system built on fractional reserves that never expected mass physical delivery demands. Now layer in the supply restrictions we've documented. China's export licensing system mathematically removes 150 to 200 million ounces annually from Western market access. Russia, withholding domestic production, eliminates another 38.5 million ounces based on their historical output, and the allocation of $535 million towards strategic silver purchases through 2027. Add those numbers together. We're looking at roughly 200 million ounces removed from the 835 million ounce global supply. That's a 24% reduction in available supply happening simultaneously with growing industrial demand and depleted stockpiles. Let me put 24% supply reduction in context using something familiar. Imagine if 24% of American gasoline supply suddenly became unavailable, not because of refinery problems or shipping disruptions, just gone. Withheld by foreign producers who decided they'd rather keep it for themselves. Gas prices wouldn't just edge up gradually, they'd spike violently as everyone rushed to secure whatever supply remained. The same dynamics apply to silver, except most Americans never think about silver the way they think about gasoline. Until their solar panel installation gets delayed, or their electronics cost more, or their investment portfolio takes unexpected hits. The price action already confirms the shortage is real and intensifying. Silver broke through $65 per ounce in December 2025, marking a 142% increase year over year. That's not gradual appreciation from investment demand or inflation hedging. That's a market screaming that physical supply cannot meet delivery demands at suppressed prices. And remember, this happened while ComEx paper futures remained artificially anchored between $30 and $35 for months. The physical market is trying to tell us something the paper market refuses to acknowledge. Bank of America's commodity research team published projections in late 2025 targeting silver at $65 or higher by Q4 2025, a forecast that proved conservative as prices hit that level weeks earlier than expected. Independent analysts specializing in precious metals markets are now targeting $80 to $100 by mid-2026, based on current supply deficit trajectories and the compounding effects of Russian withholding and Chinese export controls. These aren't fringe predictions from gold bug websites. These are institutional research teams and professional commodity analysts revising estimates as new data confirms the structural shortage. What drives prices from 65 toward 100? The shift from paper to physical as the primary pricing benchmark. For decades, ComEx futures prices set global silver values because the exchange had enough physical inventory to maintain credibility. If futures traded at $35, physical silver generally traded near that level with small premiums for delivery and handling. But when physical silver in Shanghai trades at $80 while ComEx futures quote $35, the exchange loses pricing authority. Buyers who need actual metal will pay Shanghai prices, not paper prices that don't deliver physical silver when demanded. This repricing mechanism already happened in other commodity markets where physical shortages emerged. Lithium prices diverged dramatically between paper contracts and physical delivery in 2021 and 2022 as electric vehicle demand exceeded supply. Rare earth elements experienced similar disconnects when China restricted exports and Western buyers scrambled for physical material. In every case, physical prices eventually pulled paper prices higher, because reality cannot be indefinitely suppressed. Paper markets only function when they can deliver physical commodities upon demand. When delivery fails, paper prices become irrelevant. The timeline for this repricing in silver markets is compressed and accelerating. China's export restrictions took full effect January 1st, 2026. That's not a future concern. It's happening right now as you watch this. Russia's strategic accumulation continues under their $535 million budget allocation through 2027. Every month that program continues removes more physical silver from Western access. ComEx faces delivery demands it cannot satisfy with current registered inventory levels. The mechanisms triggering the crisis aren't building slowly. They're already in motion. Here's where the conversation gets uncomfortable for anyone holding paper silver investments. What happens when ComEx cannot deliver physical silver to contract holders who demand it? The exchange has several options, none of them good for paper investors. They can declare force majeure, essentially defaulting on delivery obligations by claiming circumstances beyond their control. They can offer cash settlements at current paper prices to contract holders who wanted physical metal. Or they can allow physical prices to run freely until they reach levels where existing inventory holders agree to sell. Force majeure default would devastate confidence in futures markets broadly, not just silver. If ComEx can't honor delivery obligations on one commodity, why should traders trust any commodity exchange? Cash settlement at paper prices creates a massive wealth transfer from investors who bought contracts expecting physical metal or equivalent value to the exchange and dealers who benefit from settling delivery obligations at suppressed prices. Allowing physical prices to run freely means paper prices must adjust upward to match reality, vindicating everyone warning about the disconnect, but crushing short positions and paper holders who thought they had silver exposure at lower prices. The window for positioning ahead of this adjustment is closing rapidly. We're in Q1 2026 right now. China's restrictions are fully implemented. Russia's accumulation continues. ComEx inventory drains with each delivery demand. Industrial buyers increasingly bypass exchanges entirely and negotiate direct supply agreements with miners and refiners, further reducing available supply for spot markets. Every week that passes without resolution increases the likelihood of a disruptive repricing event rather than a gradual adjustment. Let me bring this back to you personally because understanding the system is only valuable if it informs better decisions. If you own silver through ETFs, examine the prospectus carefully. Does the fund hold physical metal or derivatives contracts? Can they guarantee physical delivery if you redeem shares, or do they settle in cash based on spot prices that might be far below physical market prices? These questions never mattered when paper and physical prices tracked closely. They matter enormously when $80 Shanghai silver trades alongside $35 ComEx futures. If you're planning major purchases that depend on silver supply, like solar panels or electric vehicles, consider whether current delivery timelines are reliable, Manufacturers already report supply chain stress for silver-intensive components. Those problems will intensify as Chinese export restrictions limit availability and Russian withholding removes more supply. Locking in current prices and delivery dates might save substantial money and frustration compared to waiting and hoping supply conditions improve. If you're managing retirement assets or investment portfolios, understand that silver market disruption creates ripple effects across sectors. Technology companies need silver for manufacturing. Renewable energy firms depend on silver for solar panels. Defense contractors use silver in weapon systems and electronic warfare equipment. Financial institutions holding short positions or derivatives exposure face potential losses if physical delivery demands exceed available supply. Your portfolio carries hidden silver exposure through channels most advisors never consider. The mathematical endgame isn't speculation, it's arithmetic. Annual deficits of 200 to 300 million ounces drain remaining stockpiles. Stockpiles already depleted by 40% or more since 2021 cannot sustain continued deficits. Russia removing 160 million ounces and China controlling access to 60 to 70% of supply creates supply cliff while demand grows. ComEx registered inventory of 82 million ounces cannot satisfy sustained delivery demands at December pace. Industrial demand of 680 million ounces and growing cannot be meaningfully reduced because manufacturers need silver for production regardless of price. When you accept these mathematical realities, the conclusion becomes unavoidable. Something has to give. Either ComEx defaults on delivery obligations and destroys confidence in paper markets, or paper prices adjust violently upward to match physical reality, or industrial production gets curtailed because manufacturers cannot secure necessary silver supplies, or some combination of all three. Each outcome represents significant wealth transfer and economic disruption. The only question is which happens first and how violently the adjustment occurs. This brings us back to that warehouse manager from the beginning of our conversation. The phone kept ringing. Customers kept demanding physical delivery. The silver that was supposed to be there, that was promised to multiple parties, that generated fees and profits for years, suddenly had to materialize. And there wasn't enough to go around. That manager faces an impossible choice. Admit the scheme failed and accept the consequences, or try to delay and hope something changes. But hope isn't a strategy when the math runs against you. Our silver markets face the same impossible choice right now. For decades, the system operated on assumptions that worked as long as nobody tested them too hard. Most investors were happy with paper returns. Most industrial buyers could source physical supply. Stockpiles buffered temporary imbalances. Those assumptions no longer hold. Russia and China are testing the system deliberately. Industrial demand is testing it structurally. ComEx delivery demands are testing it physically. And the warehouse is running out of silver to deliver. The wealth transfer happening here isn't theoretical or distant. It's the largest commodity market repricing event in decades, unfolding in real time, and positioning determines who benefits versus who suffers losses. Physical silver holders will see the value of their metal rise as scarcity becomes undeniable. Paper contract holders face counterparty risk and potential cash settlements at suppressed prices. Industrial users will pay premium prices or face production disruptions. Investors who understand these dynamics and position accordingly can protect portfolios and potentially profit from the adjustment. Those who don't understand, or who assume paper and physical silver remain equivalent, face the consequences when the disconnect becomes impossible to ignore. $535 million from Russia. Export control over 60 to 70% of global supply from China. 230 million ounces annual deficits. 82 million ounces registered ComEx inventory against 47.6 million ounces delivered in 4 days. These aren't predictions or opinions. These are documented facts that lead to mathematical conclusions about what happens next. The only remaining question is whether you understand what's happening while there's still time to act on that understanding, or whether you'll understand it only after the warehouse manager hangs up the phone and admits there's no more silver to deliver. If you made it this far, you're exactly the kind of person who deserves to know what's really happening with our money and markets. Thanks for trusting AG to break it down. Hit that subscribe button and drop a like if you want more financial intelligence that actually respects your time and intelligence. Until next time, keep your eyes on the numbers, not the noise.